In this presentation, we're going to look at a Contra account. In this case, it's a discount on bonds payable. For example, here we issue a bond for $100,000 the face value, and with the prevailing interest rates, we get only $96,150. So we receive cash of $96,150 as an asset, but we got a liability sitting here on a bonds payable for $100,000. So we need a balancing entry here. So what we use the discount on bonds payable. So the balancing entry here would be to debit discount on bonds payable for $3,850. So our assets balance with our liabilities. We get the $100,000 here minus the $3,850. That balances with the assets here of cash of $96,150. So as time goes on, we have to build up our carrying value here of the bond to $100,000 since it's currently only $96,150. So we do that through this Contra account. So if looking here at the Contra account, we've got a debit plus, credit minus, and up here on our bonds payable, it's a debit minus, credit plus. So they're working in opposite directions. So each period we reduce our discount here, which increases our carrying value on the bond. So we go through here, charge that off each period, and then when we get down to the end, we've charged off all of the discount or the Contra account amount here of $3,850. So these net out to zero. And at that time, our bonds payable here as a liability would be up at $100,000. So if we look at it here in this little chart, we started out with a discount net amount here of $3,850, and then the bonds payable was $96,150. That was our initial at the issue date of the bond. Then as time moves on, we kept on reducing that discount until we get down here to zero, and our bond payable was increasing each period until it got up to $100,000. So at maturity, we've got a $100,000 liability for the bond on the balance sheet, and that's what we want because that's what we have to pay off on that bond. Okay. Here we're going to look at the balancing entry for this discount bonds payable. So as we looked here, each semi-annual payment we reduced this discount amount here. So we got down here to $38,150 at the end. Well, the balancing entry to the discounts payable would be interest expense. So we credit discounts payable and we debit interest expense. So we increase the interest expense by the amount that we decrease the discount on bonds payable. And why did we consider it an expense? Because when we initially issued the bond, we had a book value or net value of a liability of $96,150, and now at maturity we have an actual liability of $100,000 that we have to pay back to our bondholders. So it makes perfect sense that we would charge that off as interest expense, and then that flows back into from the income statement back onto the balance sheet at the end of the period, and effectively reduces retained earnings. Okay, on this slide I'm just listing the different Contra accounts that we'd typically encounter. So on the assets here, we have a Contra assets. There's a listing for those. Accumulated depreciation, depletion, amortization, and so on. And then for liabilities, we have discounts on notes payable, bonds payable. And then we have Contra accounts for revenues, would be like sales discounts, sales returns and allowances. And then we'd have Contra accounts for cost of goods sold, would be like a purchase discount, purchase returns and allowances.